Before we start, lock this in. What you're watching unfold is not a random market story. It's a system story. It's the predictable outcome of a 4-stage cycle that repeats whenever a debt-heavy world tries to build a new industrial era, while strategic rivals fight over the same bottlenecks. Here's the shocking claim, stated plainly. The Silver War with China isn't a meme or a metaphor. It's the early phase of a balance sheet conflict where a critical industrial metal is being pulled into national security logic. And once a resource crosses that line, it stops behaving like a normal commodity. Price becomes policy, supply becomes leverage, and the public only notices after the rules have already changed. Let me prove the urgency with 3 hard numbers. Number 1, global debt is hovering near $346 trillion, about 310% of global GDP, according to the Institute of International Finance. That means the modern system is built on promises that must be rolled forward forever, because paying them down in real terms would require either austerity so severe it breaks politics, or inflation so persistent it breaks trust. Number 2, the physical silver market has been running repeated deficits. In 2024, demand exceeded supply by about 148.9 million ounces, another year in a string of shortages. Deficits don't mean the world runs out overnight. They mean inventories get drawn down, margins compress, and the system becomes hypersensitive to shocks. Number 3, solar deployment is now operating at a scale that rewires supply chains in real time, between 553 and 601 gigawatts of new installations in 2024 alone. Solar is not a side project anymore. It's an industrial mobilization, and silver is one of the metals that makes that mobilization possible. Debt this large, plus scarcity this persistent, plus a strategic rival willing to weaponize supply chains equals one outcome: conflict over control of inputs. Now the inevitability statement, the part people resist because it sounds too deterministic, but it's not ideology, it's math. When a system has more claims than real resources, and then tries to sprint into a new build-out that requires those resources, it must choose who gets them. That choice will be made through prices, policy, and power. The only question is whether you understand the machine before it turns. So I'm going to give you the machine. 4 stages. Chronological, universal. And once you see it, the present stops feeling confusing. Stage 1 is the setup. A stable order forms. Inputs are abundant enough, promises are believable enough, and the rules are accepted widely enough that people confuse stability with permanence. Stage 2 is expansion. The order scales. Debt expands faster than the real base. The system learns it can borrow tomorrow's production to solve today's problems. At the same time, supply chains stretch and specialize, because everyone believes the rules will hold. Stage 3 is crisis. The real world pushes back. War, scarcity, political fracture, technological shifts. The promises can't all be kept at once. Confidence starts leaking. Leaders respond the only way Stage 3 systems respond: controls, subsidies, restrictions, narratives, and force. Stage 4 is the outcome: reset, repricing, redesign, or re-anchoring of money. Wealth and power relocate, often quickly. The system becomes something new, but the transition is never smooth because the reset is how the system pays for the lies it told itself in Stage 2. Now you might say, that's a neat story. Good. Skepticism is healthy, so we're going to do what the system demands: test the mechanism against history, not one example. 3 separate case studies, different centuries, same cycle. If the cycle holds, then what's happening now isn't a surprise. It's a scheduled event. And here's the promise, because I'm not going to let this stay abstract. Near the end, I'll give you the single simplest tell that Stage 4 has begun, the one indicator that shows up right before policy starts replacing markets. If you only remember one thing from this entire video, it should be that. First case, Rome, the denarius, and the debasement spiral. Stage 1, setup, credibility. The silver denarius is trusted. The empire expands, taxes flow, trade routes stabilize, money feels solid because power is solid. Stage 2, expansion. Costs outgrow easy gains, armies must be paid, borders must be defended, politics becomes expensive. So the state does what debt systems do when they can't raise enough real revenue. It stretches the unit of account. The silver content of the denarius declines over time. The face value stays, the substance shrinks. Claims multiply against the same base. Stage 3, crisis, people notice. Prices rise. Soldiers demand more pay because their coin buys less. Tax collection becomes harder because citizens resist trading real goods for diluted money. The state responds with tighter controls and heavier extraction. That response doesn't restore trust. It accelerates fragmentation in the real economy. Stage 4, outcome. The monetary order effectively resets through coercion and contraction. Complexity collapses into local survival. Power centralizes as the state tries to force reality to match promises. The lesson isn't coins were bad. The lesson is, when you dilute the anchor to fund overextension, trust dies, and the system reorganizes around control. Second case, Spain, New World Silver, and the price revolution. Stage 1, setup. In the 1500s, Spain gains access to enormous flows of silver from the Americas. The crown treats this as a permanent foundation. Creditors treat it as collateral. The empire's commitments expand because the metal makes the future feel guaranteed. Stage 2, expansion. Spending scales faster than production. Wars across Europe. Fleets, administration, borrowing against future shipments. And here's the paradox. Abundance becomes a trap. When easy money arrives, discipline disappears. Domestic production lags because importing is easier when you can pay with silver. Stage 3, crisis. The silver floods the system and prices rise across Europe. Spain becomes dependent on imports, and its silver leaks outward to pay other nations for real goods. Military costs climb. Fiscal stress returns again and again. Defaults and restructurings become a rhythm. The empire strains. Stage 4, outcome, Spain's relative power declines. The flow of silver continues, but it no longer buys dominance because the system's productive base never caught up with its claims. The lesson is brutal. Having the metal isn't enough. If your promises outrun your real capacity, your advantage becomes someone else's input. Third case, United States, Bretton Woods, and the Nixon shock. Stage 1, setup. After 1944, a global monetary order forms. With the dollar linked to gold, U.S. reserves and industrial dominance make trust feel rational. Stage 2, expansion. Global trade grows, the world needs dollars, and the U.S. takes on huge domestic and military commitments. Dollar claims pile up abroad while the gold anchor stays finite. More claims, same base. Stage 3, crisis. Foreign holders doubt convertibility. Pressure builds. In 1971, Richard Nixon closes the gold window, ending convertibility. The anchor breaks. The 1970s deliver inflation and commodity shocks. The public learns the hard rule. When the math fails, rules get rewritten. Stage 4, outcome, a fiat money era locks in. The system is rebuilt on new rules and asset or commodity dynamics change permanently. Again, claims exceeded the anchor, crisis forced a policy rupture, and the world moved into a new regime. 3 eras, same skeleton. Now we apply it to today. And this is where the Silver War stops being a catchy phrase and becomes a cold checklist. Stage 1, setup. A debt-based, globally interdependent economy optimized for efficiency, not resilience. After 2008, the world stabilized through cheap money and expanding balance sheets. Promises multiplied because that's what debt systems do when they postpone pain. Global debt near $346 trillion. So that's not just a number. It's the gravitational field of the entire era. Check. And globalization created another pillar of the setup. Long supply chains and minimal inventory. The world treated critical inputs like they would always be available because the last 30 years trained everyone to believe friction was temporary. Setup complete, verified. Stage 2, expansion. Electrify everything. Digitize everything. Build the future at industrial scale. This is the green industrial push. Solar, EVs, grid upgrades, data centers, defense electronics, sensors, automation. Each of these is metal intensive, and silver is the conductor running through the nervous system of modern tech. Meanwhile, the silver market keeps printing the same signal, deficits. In 2024, the market deficit remained high at 148, 9 million ounces. At the same time, solar PV added another record year of installations, 553 to 601 GW in 2024. Now pause and feel what that means. You're scaling a technology stack that depends on a constrained input while financing the scale-up inside a system already saturated with debt. That is stage 2 in pure form. Expansion of commitments, faster than the real base can respond. Undeniable. Stage 3, crisis. Scarcity meets geopolitics, and cooperation becomes conditional. Here's where most people get lost, so I'm going to make it brutally simple. With one question: what happens when the metal you need is in deficit, and the manufacturing superpower you're competing with treats raw materials as leverage? Answer: you stop relying on markets and start relying on control. The crisis has 3 layers. Layer 1 is physical. Repeated deficits mean inventories are being drawn down and the system gets twitchy. 1 shipping disruption, 1 mine disruption, 1 regulation, and prices jump. Layer 2 is industrial. The moment a critical input starts threatening margins, industry begins redesigning under pressure. That pressure doesn't show up as a headline first. It shows up as quiet engineering choices, supplier negotiations, and substitution projects. It's the economy admitting, without words, that the old assumption, inputs will be cheap and available, is dead. Layer 3 is geopolitical. China has expanded export restrictions on multiple critical minerals through licensing requirements and targeted controls, explicitly framing them through national security. And China's export controls have, in other cases, kept some critical mineral shipments at historically low levels, even when prices rise globally. Even if silver itself isn't the only metal in the crosshairs, the message is unmistakable. Supply chains are now part of statecraft. And once one major power normalizes that behavior, every other power copies it, because dependence becomes a vulnerability that voters eventually punish. This is stage 3. Control replaces efficiency. Politics replaces price signals. Scarcity stops being an inconvenience and becomes a security threat. Check. Verified. Undeniable. Now stage 4, the outcome, what this cycle produces next. I am going to give you the stage 4 outcomes in the order they tend to arrive, because this is where people either wake up or tune out. So I'm keeping it tight and concrete. Outcome 1, repricing. The metal moves to a level that forces behavior change. In normal times, higher prices attract supply and reduce demand. In stage 4, higher prices also attract stockpiling and strategic buying, meaning the price has to rise higher than people expect to actually change behavior. That's why stage 4 moves feel irrational. They're not irrational, they're multiplayer. Outcome 2, rationing by structure. Not official rationing at first, structural rationing, long-term contracts, priority allocation, friendshoring, and supply agreements that quietly decide who gets metal and who waits. The market still exists, but it becomes the leftovers market. Outcome 3, redesign. Industries adapt. Solar keeps pushing silver thrifting and alternative designs because it has to protect its cost curve. And here's the trap. Redesign reduces pressure in one channel, but it increases pressure elsewhere because redesign shifts demand to other materials and other bottlenecks. The system doesn't remove scarcity, it migrates it. Outcome 4, the monetary narrative returns. In a world where debt is extreme and trust is cyclic, monetary metals regain attention, not because everyone becomes a historian, but because people sense, correctly, that promises are more fragile than advertised. And this is why silver is uniquely explosive. Gold is primarily monetary. Copper is primarily industrial. Silver is both. It's a conductor for machines and a refuge for minds. When those two roles activate in the same decade, you don't get a gentle cycle. You get a squeeze that shows up in headlines as volatility, but functions as a strategic scramble. Now we talk about China directly, because this is where the script must earn your attention. China isn't just another country in this story. China sits at a crucial intersection. It is a dominant force in the manufacturing ecosystem that turns metals into finished technology. And it has demonstrated a willingness to use mineral policy as leverage. That means pressure can be amplified even without touching a mine, because controlling the factory is control over the destination of the metal. And this is the part most people miss. Modern conflict is about choke points, not just territory. It's about who controls refinement, processing, manufacturing, shipping, standards, and licensing. When you hear Silver War, translate it into its real meaning. The fight over who gets to build the next industrial system without being throttled by a rival. Now, remember the promise I made, the single simplest tell that stage 4 has begun. Here it is. When governments start treating industrial inputs like defense assets, you are no longer in a market cycle. You are in a security cycle. The tell is not a price spike. Prices spike all the time. The tell is policy language, national security, strategic stockpile, export licensing, trusted supply, critical minerals, domestic sourcing. When that language becomes normal, stage 4 is already starting because policy is stepping in to allocate what markets can't allocate calmly. Now, I'm going to do one more retention critical thing. I'm going to give you a way to test this video against reality over the next 6 to 18 months. If this is truly stage 3 moving into stage 4, you will see more of the following in more countries, more frequently. You will see critical mineral lists expand. You will see subsidies tied to domestic sourcing requirements. You will see quiet stockpiling and louder messaging about security of supply. You will see more long-term offtake agreements between miners and manufacturers. You will see redesign efforts accelerate, paired with new constraints and substitute materials. And you will see trade language shift from free to trusted, because the language always changes before the rules do. If those things increase, this cycle is confirmed. If they reverse across multiple economies for a sustained period, then we can talk about de-escalation. But stage 3 systems rarely reverse without a shock, because the incentives punish leaders who choose dependence. Now, the most important part of the video, the part that decides whether this is useful or just scary. What do? First, stop outsourcing your worldview to headlines. Headline thinking destroys you in stage 4 because it makes every shock feel isolated. The antidote is the mechanism. Setup, expansion, crisis, outcome. If you can locate the stage, you can anticipate the behavior of governments, industries, and markets. Second, reduce fragility. I'm not telling you to panic buy anything. I'm telling you to stop living as if the cheapest, smoothest supply chain of the last 30 years is guaranteed to return. In a fragmentation era, the winners are the people with buffers, skills, flexibility, cash flow discipline, and low leverage. Third, learn to separate price from meaning. Price moves are not just about making money. In stage 4, price moves are signals that a bottleneck is tightening. Watch the bottlenecks, not just the candles. And finally, tattoo this in your mind. This time is different is the sentence that bankrupts optimists. Exceptionalism doesn't repeal arithmetic. Optimism doesn't neutralize scarcity. And technology will save us isn't a plan, because technology is made of atoms. And atoms come from supply chains that can be interrupted. So here's the final warning, delivered as cleanly as possible. The silver war with China is escalating fast, because the system has entered the part of the cycle where metals become strategic, debt becomes a vulnerability, and control becomes the default response. Global debt is enormous. Silver deficits are persistent. Industrial build-out is accelerating. Mineral leverage is rising through export licensing and controls. That combination doesn't cool off with speeches. It resolves through repricing and restructuring. If you want to stay ahead of this, don't chase the news. Track the stage. And if you want the next level, the part most people never see, then you need the next video. Because next, we're going to break down how the machine was built, how debt systems trap governments into scarcity conflicts, how supply chains become weapons, and what happens in the next stage of the pattern so you're not caught reacting when everyone else is repositioning. Subscribe, because the system is revealing itself in real time. And the people who survive resets are not the people who guessed a chart. They're the people who understood the mechanism before it became obvious